Good afternoon, everyone. I'm Dave Duncan, Chairman and CEO of Duncan Financial Group. I appreciate you taking the time today to attend our webinar about investing after the election. A couple of housekeeping items before we get started. We will be taking questions as the seminar goes on. We are having all the attendees in mute because the number of people here is substantial, so we don't want to be able to have everybody talking. So everybody's going to be on mute. If you have a question, use the chat feature and ask the question to the panelists. You'll see that on your drop-down menu, and we'll attempt as best we can to answer the questions as our webinar goes on. We will try to save a little bit of time at the end in order to be able to answer the other questions. And if there's leftover questions that we haven't had a chance to address either of those two ways, we will follow up with everybody, as we do have everyone's email address. Thank you all again for attending. It's very important that we consider how to invest our money. The election here has been very monumental in its impact, we believe, on our country's future. And it's very important to understand our investment philosophy. As you think about working with a financial advisor, it's real important that you understand our investment philosophy and that you share the same philosophy. We're then going to talk about some tax issues that have been proposed that we think you need to be thinking about today. I'll reemphasize this during that part of the presentation. These are only proposals. They are not law, but it's important to try to anticipate what changes might be occurring and how you might rearrange your affairs to take advantage. We're going to talk about our investment process, how we go about building portfolios for our clients. We're going to talk about how investing, in our opinion, should integrate with your overall financial planning. We're going to talk a little bit about what a client experience looks like for those people who are clients of Duncan Financial Group, and then talk about what's next. What are the important investment considerations that we see coming up over the next couple of years due to this election that we just had. I think it's important as you begin to understand our investment philosophy. We strongly believe that you need to start with a plan, and that plan will be the framework for all of your strategic and tactical investment decisions that as you go forward. Most often we talk to clients about their retirement plans. When do you want to retire? How much money do you want to have in income in retirement? How are you saving money for retirement now? We can start with a plan that'll get you to your retirement goals. And most importantly, that plan will determine what your required rate of return is in order to meet your income and income and retirement objectives. That plan should also include a philosophy. It should include a way of thinking about investing. And the way we think about investing is that for your core retirement money, now I'm speaking as, you should have the money invested in mutual funds and ETFs if you're more than 10 years from retirement. We believe that a diversified portfolio of mutual funds and ETFs will provide you with the best return on your money for your core retirement. What we do think, though, is that when you get closer to retirement, now you begin to start thinking about, how am I going to generate an income from my investments? Mutual funds and ETFs are very, very good for the growth phase, the accumulation phase of your lifetime. But we believe individual dividend paying stocks and bonds are much more valuable in the income phase of your lifetime. So we gradually transition our clients' portfolios over to individual stocks and bonds as they approach retirement. It's very, very important for you to monitor your portfolio. We choose mutual fund and exchange traded fund managers to make up our clients' portfolios when they're in the accumulation phase. Those mutual fund managers sometimes retire, sometimes they change jobs. Unfortunately, sometimes they pass away. So we're constantly monitoring what these mutual fund managers are doing and make sure that they're among the best in performance in the category that they're in. But I can't emphasize enough that the patience and discipline that you will need to show in your accumulation phase and in the income phase of your retirement is very, very important. Stick with a long-term plan, have the patience and discipline to stick with it when the market is doing poorly, and over a long period of time, you'll be very well rewarded in our opinion. I'd like to now turn it over to Anthony Marciano. Anthony is an enrolled agent in our tax and accounting division, and he is going to talk about some of the proposals that may come to fruition here in our next administration. Anthony?
Thank you, Dave. Good afternoon, everyone. As if calendar year 2020 was not taxing enough, it appears as though with any new administration, the financial and economic proposals that come along with that new administration, the tax side being one of them, will in fact provide some additional taxing headaches as we enter into 2021. Once again, as Dave had mentioned, these are merely proposals, but they are ideas that we do need to keep in mind, not only as we exit out of this calendar year, but as we prepare for the new year to come. The only significant change in tax rates is at the highest marginal tax rate. And that rate is only for individuals with taxable income over 400,000. And what we're going to see there is we're going to see the highest rate, which is now at 37%, that will grow to 39.6%. There's also a significant change with regards to Social Security taxes on earnings, that is on earned income, wages. As you may or may not know, for calendar year 2020, the first $138,000 of wages has a Social Security tax that is imputed on that, on the employee and also on the employer. And that is capped out at 6.2%. And thus, for any wages over $138,000, neither the employee nor the employer pays that Social Security tax. Well, under the proposal of the Biden administration, there is going to be a donut hole, meaning that from 138,000 up to 400,000 of wages, there will be no Social Security tax imputed on either the employee or the employer. However, that rears its ugly head once the individual hits $400,000 in wages. The 6.2% income tax, if you will then come back onto the wages of those individuals. So once again, from 138,000 up through 400,000, no Social Security tax. However, for wages over 400,000, that same 6.2% that was taxed on the first 138,000 now comes rearing back at 400,000. A significant increase in tax rates on capital gains and qualified dividend income comes back into play in 2021 under a proposal by the Biden administration. However, we do foresee this affecting fewer and fewer individuals because that is only imputed on individuals in couples whose income is in excess of $1 million. However, if your income is in excess of $1 million, the current now 20% qualified dividend and capital gains rate now jumps to the highest proposed federal income tax bracket of 39.6%. So essentially what we're seeing is the doubling of the tax rate on capital gains and qualified dividends on those individuals whose income is in excess of $1 million. You're hearing the number of 400,000, and that is very popular under the Biden proposal. We're seeing those whose taxable income is over 400,000. We're seeing the resurgence of the income limitations for qualified deductions. So any and all itemized deductions on those individuals or couples whose taxable income is over 400,000 we're seeing the limitation of up to 80% of itemized deductions. Those had reared its ugly head before the recent Trump income tax legislation that was to be effective for calendar years 2018 through 2025. That was removed. However, we're seeing that possibly come back into play under the Biden administration. So the qualified itemized deductions can be limited now to up to 80% for those individuals and couples who have income over 400,000. Once again, for those small business owners, be those LLCs, partnerships, S corps, sole proprietors, so many of our small business clients saw a significant benefit in 2018 and 2019 under what was referred to as the QBI, or the Qualified Business Income Deduction. That was essentially a 20% deduction on any net income or pass-through income for any type of a business entity, excluding that, of course, of C Corps. Well, now for those individuals or pass-through shareholders whose taxable incomes are 400,000 or more, the Biden administration is proposing to cut into or limit that 20% QBI deduction. So as we exit out of 2020, a controversial in prior years recommendation, we are now recommending that you actually defer your expenses into next year if you are able, and to accelerate your income into this year. Because ultimately, if the 20% deduction is going to be alive and well in 2020, then we want to make sure that we maximize our profits. So where possible, we're recommending accelerating your income into 2020 and deferring your expenses into 2021. And finally, the two other items of negativity that I would like to highlight under a Biden proposal would be the adjustment of the estate and gift tax exemptions for 2021 and beyond. Right now, for a single person, your estate limitation, your exemption is 11.6 million. For a married couple, we double that to 23.2 million. Under the Biden proposal, those numbers are going to revert back to the 2009 levels. So for an individual, the estate exemption is going to go from 11.6 million all the way down to a trickle at 3.5 million. And for a married couple, right now at 23.2 million, that is going to go down to 7 million. So a significant proposal there with regards to estate exemptions. And finally, with regards to corporate income tax rates, there was an agreed upon in Congress under the Trump administration to lower the flat tax, if you will, for corporate income tax rates down to 21%. Under the current proposal of the Biden administration, they want to ratchet or yank that tax up to a flat 28%. So essentially about a 40% income tax rate increases for your C Corps, none of which could be also your small businesses, but they could also be your publicly traded companies. So the Biden administration wants to ratchet those up from 21% to 28%. And those at Duncan Financial Group, we also do want to strive and look for silver lining. We want to look for hope in the midst of chaos. We want to look for sunshine in the midst of the rain that we've seen here in 2020. And there are a couple of encouraging signs under the Biden proposal, just three of which we want to highlight here at a very high level. The first is going to be the expansion of the dependent care credit. So currently for working parents, for those individuals who have one child, that credit had been 20% of $3,000 of qualified dependent care expenses, which would max out at a $600 dependent care credit. Under the Biden proposal, they're looking to ratchet that number up to $8,000 of qualified dependent care expenses at a 20% rate. So that would be a $1,600 credit. And then for the second child, and it caps out at two individuals, as opposed to $6,000 currently at 20% or a $1,200 dependent care tax credit. The Biden administration is looking at taking qualified expenses of $6,000, increasing them to $16,000. So maxing out that credit, whereby now at $1,200, that would now be raised to $3,200. And also a change to the child tax credit. This would be for those children who are under the age of 17. The Biden administration is looking at taking that child tax credit from $2,000 up to $3,000. And for those families who have a child under the age of 6, they're looking at putting in an additional bogey of $600. So that would go from $2,000 all the way up to $3,600. And the final credit that I would like to cover here this afternoon would be with regards to the first-time home buyers tax credit. If you remember, that had come into play during the doldrums of the real estate industry of 2007 to 2009. And that had been yanked back out of the code, but that is now coming back into play under the Biden proposal. They're proposing a $15,000 first-time home buyers tax credit. And the proposal does not outline the definition of what a first-time home buyer is, but if it is very similar to the previous credit, that would be a homeowner who within the past 2 years did not have any type of primary ownership in a primary residence. So our recommendation is, if you are looking at considering purchasing a home in this year, 2020, with some closings able to be completed within 30 to 45 days, so that would be possible to close or execute a purchase agreement in calendar year 2020, we are recommending, due to tax reasons, to quite possibly consider postponing that into 2021 to see if the first-time homebuyer tax credit would come into play. And one final note, as opposed to having to wait until you would previously have had to file your tax return in order to see that first-time homebuyer tax credit, now under the current Biden proposal, you're actually able to receive that $15,000 homebuyer tax credit at closing. So you would be actually accelerating that credit at closing in 2021, as opposed to having to wait until you file your tax return in 2022. So once again, those are the major taxing proposals for 2021, with, of course, a nice bright sky, a bright sunshine for some individuals who have children and who are looking to purchase their first home. So that is it for me. Back to you, Dave.
Thanks, Tony. Appreciate that. Nice presentation. Again, I would remind everybody that what we just discussed were proposals. They are not the law yet, but anticipating what may and may not occur, as Tony mentioned, can help you save taxes or gain some credits you otherwise may not have been able to achieve. As we think about investing money for our clients, as I said earlier, it's very, very important that you have a process, and core to our process is our investment policy committee. 25 years ago, we formed a committee of our then investment professionals so that we could collaboratively work together and figure out, using our experience and brainpower, what are the best large cap growth funds for our clients to own? What are the best international funds? What are the best small cap growth funds? What are the best consumer staple stocks, et cetera, et cetera. So to talk a little bit about our investment policy committee, Rob McCalmont, one of the original members of that committee. Rob?
Thank you, Dave. I just wanted to introduce to you our team. We basically, it's called an investment policy committee, but it is a good group of financial advisors. It's a great group of a team here. Along with every panelist that you have here on this meeting, we have a total of 22 members, and each one of those members has a different knowledge base, and they went to different schools. They're actually in different states, and they have different backgrounds. So what we ended up with over 380 years of a combined investment experience, and we have a lot of different states covered, like Kentucky, like Missouri, even California. So we have a very good group of diverse financial advisors that give you a really good background to pick and choose mutual funds and ETFs and individual stocks. We do have a disciplined long-term approach. Like Dave said, we've been doing this since the mid-1990s. We've had consistent weekly meetings every Monday morning. We try to get together, and basically that gives you the consistency. We don't only just go through the numbers every week. We also talk about ideas. Every once in a while we put the analysis of the funds away for a week to talk about the election, or to talk about what the market is doing, if there's some significant changes. So just wanted to introduce you to the team. We're very excited to use this team to, first of all, give you the best funds that are available out there, the best ETFs that are available, and that's what we try to do. Dave?
Thanks, Rob. Appreciate that. So that's the committee. That's the personnel. Let's have Alex Klein from our investment policy committee talk a little bit about how do we select a manager? What are the issues that we look at to pick what is the best managers across the board?
Thank you, Dave. And hello, everybody. I'll just take a few minutes to talk a little bit about, as Rob said, our investment policy committee and the process we use when we look at funds and ETFs. And the first thing on your screen you see is style purity. We're looking for, and we analyze funds to make sure that that fund is buying what they're supposed to be buying, the underlying stocks. For example, if we have a large cap growth fund, our job is to make sure that that fund is buying large cap growth companies. With the large cap value fund, our job is to make sure that that fund is buying large cap value companies. Management tenure, it's very important. Okay, we're not interested in what a manager can do over a 3-month period, 6-month period. We're professional investors. We're not traders. Traders are what you see every day on CNBC and Bloomberg and all that. Oh, stocks up, stocks down. But when we look at a management tenure, we're looking for those managers that have been around for a number of years. We'd like to have a manager that's been there for 5 years. We also will look at managers that have been around for a long time, but maybe have been just with a different fund company and moved over to another fund company. So management tenure, 5 years or more, we're really looking at that very closely. Performance. Everybody wants to talk about performance. One of the things we're looking at is it repeatable? Once again, I'm not worried about the fund that all of a sudden had a great year or a great 6 months. We're looking at, is the performance of that fund over a 1, 3, 5, 10-year period, is it repeatable? So when we look at performance, what we're looking at is we're opening up the hood. We always make that adage about someone, like commercials, you kick the tire, you look and the guy says, oh, this car is great, I'll take it. Well, we don't do that. We're actually opening up the hood, we're taking apart the engine, and we're seeing what actually makes that fund work. All right, so we're looking at all the different things, and I won't bore you with all the things like upside, downside capture ratio and alpha and R squared, all those things like that. But we are looking to see if the fund performance that's been generated by those managers, is it repeatable? And we think that's very important. Because remember, investing's a long-term thing. All right, we're talking 5, 10, 15 years. Investing is a long-term process. So it's very important to do that. Fund expenses, fees aren't everything, but they're very important. Okay, so we're always looking at institutional funds. Okay, looking for lower expense ratios. And the reason we do that is, remember, there's 14,000 plus funds out there. Right? Nobody's the best at everything. BlackRock, Fidelity, Vanguard, 3 biggest names that you know of. Nobody has a winner in every single category. You have BlackRock has winners in some categories, losers in others. Same with Fidelity, same with Vanguard. Okay, so what we're looking for is low expense ratios. We always look for that, but it's not going to be necessarily the cheapest, because cheapest doesn't always mean the best. So we are always going to look for the best. And remember, we're a independent investment advisor. We don't have any proprietary funds. And we think in the long run that that's pretty important. Turnover ratio. Right? We're looking for funds, and you have to be cautious of funds that have a significantly high turnover ratio, especially if you're in a non-qualified account, because that could generate some tax liability for you. And, and we think that that has an issue, and it could have an issue on the long-term performance of that particular fund. So we do spend some time. We really want to focus on turnover ratio as well. Manager skin in the game. I mean, let's face it, we're looking for managers that actually have their own money invested in the fund. It's not mandatory, but it's very important because research has shown that managers that are investing in their own fund, that their performance tends to be better over the long run. So we're looking for managers that are willing to invest in their own fund. Number of positions, we're looking at funds, and one of the things we look at is we don't want to have a closet index in there. So we don't look for a fund that has so many stocks that it just becomes a closet index, because then that's on the passive side. We are active money managers, and as you'll hear from Brian next, he'll talk about how we do some of the things we do. But it's important. So we are looking at those funds. We don't want to have a fund that's has too few positions, because then you're limited to, then you have maybe some excess volatility. But we are looking for that particular issue relative to how many individual stocks are comprised that fund. Fund flows, we're concerned. We look to avoid funds that have significant flows in and out, because that could create both positive and negative effects on that fund manager, that they have to sell positions that they don't want to sell because they have redemptions, and they have to to sell those good stocks even though they don't want to. We do look at that. So all in all, our investment process, we're looking at best in class funds. That's what we do. We're looking for that. And as I said, no family is the best at everything. There's so many different funds out there. Our job is to find the best in class funds and ETFs and build your portfolio accordingly. So with that, I'm going to turn it over to Brian Duncan.
I'll jump in there first, though, if you don't mind, Alex. Thank you, sir. Our investment policy committee has met. We've picked the good funds that we think are best in class, as Alex says. Now the decision is, how much do we put into each fund? We call that our strategic weighting process. And my son, Brian, is going to describe our strategic weighting process. Brian?
Thanks, Dad. Good afternoon, everybody, and happy Thanksgiving here to everyone. Yeah, when it comes to the strategic weighting process, we as the investment policy committee really feel like there's an opportunity to add value here in this element, in addition to the broader planning and investment strategy we deploy. I think it's important to highlight that asset allocation is a very important part of creating and balancing your overall portfolio. We take that responsibility very seriously, and we do so by setting target allocations based on our clients' goals, objectives, and risk tolerance. And so there's a sample target allocation that outlines U.S. stocks, international stocks, bonds, and cash. And the thought there is just to provide you with a high level of what do we mean by target allocations. Now, when we come to the decision around, as Dad mentioned, how much do we put in each of the categories, we take a hard look at where do we see where the puck is going, as the famous Wayne Gretzky would say. And so 3 categories that we wanted to highlight here based on our current thinking would be value versus growth, small companies versus large companies, and foreign stocks versus domestic stocks. And just a quick highlight on the value versus growth, for the last couple of years, and what has only been accelerated this year, has been the outperformance of growth. Stay-at-home stocks, your Apple, your Google, your Netflix, those have continued to perform very well. And we see now a possible rotation back into value. So while growth has outperformed for quite some time, our investment policy committee feels like a strategic overweight is in order for value. And same for small companies, and same for foreign companies as well. So we do look at, based on how a sector or category has performed, looking to the future, how can we weight the portfolio to try to add value and enhance the overall value that we bring over time. Now, the topic of strategic weighting also relates to rebalancing. It's very important, we feel, to have a process for rebalancing. And we could arguably spend an entire webinar just on the concept of rebalancing. But here we want to highlight how important it is in years like 2020. Just a quick history lesson in the year here that was the roller coaster. The Dow Jones and the S&P 500 fell to their bear market level of below 20%, 20% down from their highs more quickly this year than in any year in the past, and ultimately fell 34% at the bottom. And so what we feel is very important to include is a process for rebalancing. When you have those dips, when you have those dislocations, it provides you an opportunity to buy equities or whatever the asset class might be that has that less than stellar performance at the moment. And so when you think about rebalancing, it's a process to buy low and sell high, taking a more unemotional approach to that as we're able to deploy your assets accordingly. And we also feel like when one category has outperformed another for a significant amount of time, especially that growth versus value, there's a reversion to the mean, and we feel like other categories that have not been as favored in the market could be a good use of capital going forward. And then also when it comes to strategic weighting, what also is a boon to our efforts are the topics of exchange traded funds. As Dad had mentioned, we include these in client portfolios. They, for the first time ever here in the recent history, passed 5 trillion of assets. And exchange traded funds have a number of dimensions to them, but most notable for our clients and investors, we feel, is they do tend to have lower fees than mutual funds. So that obviously can add to the return potential over time. They also, because of their unique structure, have fewer realized capital gains. And as Anthony mentioned in the remarks regarding where the possible tax scenarios could be next year and beyond, we do feel like tax efficient investing is also very important for your non-qualified assets. So we can also with these be sector and or style specific. That's also what exchange traded funds allow us to be able to be nimble and weight the portfolio accordingly with liquidity and at an overall lower cost. So we take all this together combined as it relates to our strategic weighting and then ultimately deploy where we see the best use of capital. So with that, I'm going to turn it back over to Dad. Thank you.
Thanks, Brian. Appreciate that. I was just trying to catch out of the corner of my ear the president speaking from the briefing room there, just trying to catch some of his comments there. And while we're on that subject of the market lows that occurred back on March 23rd, we, for the quarter ended March 31st, decided to reallocate our portfolios, lightening up on bonds and increasing our allocations to stocks. And as of today, the stock market is now up 60% from its March 23rd lows. Pretty stunning result. And we certainly didn't anticipate that the market would be this good, but we are disciplined and we made the reallocation from bonds over to stocks at what turns out to be a low point. Wasn't easy to do because we didn't know what the world was going to look like then, but that's part of our discipline process. We believe that investing should be part of your overall financial plans. And I'm going to turn it over to Julie Leeper to talk about how we integrate planning for retirement, especially with our investments and our financial planning. Julie?
All right, thanks, Dave. In addition to the investment process that Brian just described, we can tie in your goals and concerns to really give a comprehensive picture of where you're at now relative to those goals. So integrating that investment management experience, the background of our policy committee, and then integrating that personalized strategy, we can create a plan for a successful retirement. Briefly, I'd like to touch on just several components that are common when we are evaluating and creating that plan. I would say probably the most common question that I get is, am I saving enough? And really that answer can vary greatly from person to person. So we'll take a look at, where are you right now? What's already saved? Is it structured properly, not only for now, but moving forward? And then also, what does your lifestyle look like, again, now and maybe 15, 20 years from now? Another topic is, am I managing my debt properly? Here we might look at just the monthly cash flows and how much of that monthly income is perhaps just going towards servicing those debts. In today's ultra low interest rate environments, we might, take a peek at that and see, is there a better option out there, possibly refinancing to save some additional money and put it to work elsewhere. The next topic would be, am I protected? And this really is just taking a in-depth look at your potential gaps that might be in your homeowners, your auto insurance, possibly your life insurance or long-term care plans. As an example, if you've accumulated any wealth over time, one thing that's often overlooked is a simple umbrella liability policy. In today's litigious world, that could be saving you, quite a bit and really protecting what you've accumulated for pennies on the dollar each year. Another topic would be, is my income going to be secure? So this is where we might be looking at retirement income planning, looking at the different sources that are coming back in. And, in pre-retirement, as Brian had touched on, we'd be looking at the best methods to accumulate and grow your savings. Now, as we approach retirement, we're also taking into consideration then the tax efficient distribution strategies that could be implemented with Social Security optimization, portfolio allocations, and possibly pension optimization to make sure that the tax consequences are most favorable and that your assets live as long as you do. Other planning considerations that are probably top of mind for many people, young and old, may be the healthcare costs that seem to be ever rising. I'd like to just highlight two of the analysis tools that we'll often use when creating a plan, where we take all of those details and really put it into more or less a one-page summary using first a Monte Carlo analysis. Very technical, it sounds like, and no, it's not the car, but what this will do is use planning software to allow us to look at your personal plan against all the future market conditions. That includes the best of markets, possibly the worst of markets, and then those in between scenarios. By running 1,000 different scenarios, we would be able to then have a better understanding of where you fall today as towards hitting your actual retirement goals, and will you be successful and have that long-term confidence to go into retirement. Another tool that we'll look at is really based on the analysis of your portfolio itself. So when designing portfolios based on your needs and timeframes, we'll often look at where you're positioned as far as risk versus reward. So that just means based on the risk levels that you might be taking in your portfolios overall. So this is everything, high level picture of where you're invested. Are you receiving the potential rewards that you should be getting based on the risk you're taking? Now, if you take a look at the slide here in front of you, we're trying to target that blue line, which is more or less our target for efficiency. And if we're falling short of that, perhaps taking too much risk or maybe too little risk, and therefore receiving too little return, there's definitely some strategies that we can use to mitigate that. And the last thing that I'd just like to briefly touch on, and this will be dived into a little bit further here in just a moment, will be the simple fact that creating a thorough plan also involves, coordinating with CPAs and estate attorneys, just to uncover tax efficiencies, make sure that your estate plans are buttoned up, and really make sure that you have a framework for wealth transfer, legacy, and possibly business perpetuation. So Dave, from here, I'll turn it back to you.
Thanks, Julie. I appreciate that. Frank Zaracki, our next speaker, has been critical to the creation of our new unit that we call Premier Wealth Management. Frank has been in the business and estate planning area for decades and brings a wealth of experience to that part of the company for us. And I'm going to turn it over to Frank.
Thank you, Dave. Good afternoon, everybody, and thank you for taking time out of your day to join us. There are some of our friends and clients and potential prospects out there that have more complex and specific needs. Our advanced planning and business succession team is here to help. The first goal is to assist those who require estate and legacy planning solutions. What we try to do at the beginning is to establish a complete understanding of a client's family makeup, their asset holdings, business and real estate holdings, as well as, and most importantly, their specific wishes and distribution goals. We call this our comprehensive fact-finding process. This process allows us to understand the client, his holdings, and again, his wishes. After that process has been completed, our next priority is to look at the overall situation and ensure husband and wife or family of lifetime income. We concentrate on this in a matter of including tax efficiency. Once we've included the tax efficiency portion and have secured the lifetime income, our next task is to review all the existing legal documents, whether they be wills, living wills, any existing trust agreements, and power of attorneys. With the understanding from the fact-finding process of the client's wishes, we are now able to review the existing documents to make sure their wishes and their goals are matched up by the necessary documents that they have in place. This is what we call reality matching perception. We now review these goals and work with the family attorney, or we have the ability to suggest someone qualified to help provide additional documentations, amendments to the existing agreements so that everything is coordinated. We also recommend highly that this process is reviewed annually to be current with any potential changes. After the necessary documents are in place, we employ certain strategies to provide liquidity for taxes. Those taxes can be anything from Pennsylvania state inheritance taxes or federal estate taxes. As Tony has alluded to earlier, there is the potential that the existing tax levels are going to change. Right now, the current lifetime gift exemption or exclusion per individual is $11.5 million. There is the potential that that may drop down back to $3 million. For husband and wife, there would be a grand total of $6 million. Today, that grand total was $23 million and change. After the $23 million of the estate tax has been met, the top tax rate then kicks in at 40%. If the limits drop to the $3 million level, there is the possibility that that tax rate will start at 45%, which will make a substantial difference in what you're able to distribute to your heirs. Another strategy that we look at regularly that is becoming more and more prevalent is the estate inheritance equalization. And that implies with respect to any properties, business interest, and assets. For instance, if you have multiple children, whether it be a step family or just children who may or may not be interested in any family businesses, how can I best equalize my estate so that everybody, if my wishes want to be included, that everybody is treated fairly? In looking at that, we work with those particular strategies to develop to satisfy the client's wishes. Some of the other situations that we look at heavily is using gifting. Right now, the annual gift per person is $15,000 to any one person that you'd like to give it to. So a husband and wife has the ability to give anybody $30,000 per year. We also employ life insurance trusts. We also look into legacy strategies for family generations. What this entails is that if you have a substantial amount of holdings, how you might best be able to take care of your children and possibly your grandchildren. The overall goal of our estate and legacy planning division is to provide a tax-efficient estate, provide necessary liquidity while preserving the maximum amount of assets and business interests for your spouse and heirs. The second phase of our advanced planning division incorporates the transition or business succession of business ownership transfers and interests. This can be done through a buy-sell agreement, a stock redemption plan. What that entails is having life insurance provided to transition the ownership of a business to another individual, whether they be a family member or potentially a key employee. This current environment has led us to look into protecting those key and most important employees of your business. Employees are jumping companies right now because there are better opportunities that are out there. So we look to help secure that if possible, to put a key man employee retention program in place. Another area that we focus on that's often overlooked, sadly, is disability income. What happens to my business if I don't die, but I become disabled? A, how's my business going to run? B, what am I going to live on? How do I protect my ownership interests for my family and heirs? This is a series of questions that comes about as far as what happens to my business if I were to die and not come back tomorrow. Do I need any documents to formalize the succession plan, or transfer of ownership? Who best in my company or my family might succeed me? And if they do, at what cost? How can I protect my spouse while implementing a succession plan if he or she is not involved in the business or the operations? How do I best maximize my business interests for today and tomorrow in terms of the money I'm able to take out in value from all the years of work and sacrifice? How can I access those funds? How can I save those funds? Another strategic area that's incorporated in our business planning division is the maximization of savings when the existing retirement plan won't allow me to contribute more earned income. That may be capped by a safe harbor retirement plan. We look strongly into salary deferred compensation plans. The two areas that I covered today are everyday concerns for those individuals who may be high income earners, may have a high net worth, or individuals who are business owners. We are here to help, and we can help. The alternatives to this are far more expensive and cumbersome. With that, thank you for your time. I'm going to turn it back over to Dave.
Thanks, Frank. Well done. Appreciate that. Those are all the things that we can do. And to talk a little bit about in more detail what our experience, what a client experience would look like, I'm going to turn it back over to my son, Brian. Brian?
Thanks, Dad. As we have mentioned a number of planning opportunities and strategies here today, one of the most important things we feel as your advisors is we must create the mechanism or the process to help you implement these. So one of the things that we aim to do is coordinate your strategy across all of your assets and all of your planning. Now, at Duncan Financial Group, one of the core platforms within our wealth management arena is what we call Click Client. Many of you may know as eMoney. And this platform serves two primary purposes. One is to be an aggregation of all of your accounts. Simply stated, if you have a user ID and password, there's a good chance you'll be able to onboard this account within our Click Client or eMoney experience. And what that does, it gives you a single source dashboard insight into all of your accounts, whether they are managed by our firm or other institutions, quite possibly your 401k or other retirement plans and savings at, let's say, a banking institution. All of those can be located in one place, in addition to all of your key documents, your estate plan, power of attorney, so on and so forth. And so it serves that purpose for us, but also to what Julie had highlighted. Ultimately, we can then utilize this system to help develop a plan for you and measure our progress to that plan over time. We feel that's a key element to the client experience. All of what we talked about here today needs to work in concert. It needs to be organized and it needs to be managed. And that's what ultimately you would hire us to do through your dedicated client service team and your advisor. We bring all of that together, all of those planning facets through our Click Client experience. And then on the next slide, just to highlight a quick dashboard of what it looks like, you would have these insights into your financial world, and you would have the support and resources of our team to help you implement this and make the review process and the planning process that much more meaningful. To the statistic there on the prior slide, 56% of people polled felt very confident about their retirement when they had an actual written plan in place, whereas only 17% of clients surveyed by Schwab felt confident about their retirement when they did not have a plan in place. So we really feel like it's critical to go beyond the concepts, to turn them into implemented strategies, and all tailor that to the individual goals and objectives that you have. And as such, it helps us have a one line of sight to all of your financial world to help you manage it, again, regardless of where those assets or accounts might be. So with that, I'm going to turn it back over to Dad to speak to some of the thoughts and perspectives we have going forward.
Yeah, thanks, Brian. Yeah, 2020 has certainly been a year that we will never forget. It's been some really, really good times and some really, really bad times. But as we look forward to 2021 and beyond, one of the big things, of course, that's in everybody's mind is the COVID and the COVID relief stimulus bill. I think we've all been very, very optimistic and excited about what Pfizer and AstraZeneca, Novartis, and all those companies have been able to do to come up with a vaccine. But I think reality is that it's going to be well into next year before we get a whole bunch of Americans vaccinated against this virus. So we just have to temper our enthusiasm. It's all good news, but we just need to be a little tempered in our enthusiasm for that. As far as the stimulus bill is concerned, our thinking is that the Biden election does increase the chances of a relief bill. I think it decreases the chances prior to Biden becoming president in January. But I do think that after that, there will be a negotiated settlement between all the parties, and they'll get some money out into the economy, which we believe will be good for the stock market. Obviously, Main Street is really suffering, and they need this stimulus bill badly. But we are concerned that this is going to be adding to a significant amount of long-term debt that we have as a country. We're not terribly worried about that because we think the economy can grow in 2021 and beyond, but we are very concerned about just the amount of the debt that we have. We also believe that there's going to be an infrastructure spending bill. A lot of the infrastructure in the US is rusting, and we need to be able to update that. We think with Biden's election that we will get an infrastructure spending bill. We're just very hopeful that it won't be excessive in its amount, adding more to our excessive long-term debt. We also believe that there's going to be tougher antitrust enforcement. It's going to be hard to measure the impact of this on the markets, but certainly there are certain businesses, oil and gas by way of example, that might be very negatively affected by what some of the antitrust enforcement might be doing out of the Biden administration. Certainly tax increases, we believe are going to be negative. It's just amazing where we are in this country with income taxes. This is from 2016. And by the way, these are not opinions, these are numbers. In 2016, the bottom 50% of the taxpayers as measured by their income paid a total of 3% of our income tax. The bottom 50% combined paid 3% of our income tax. The top 1% of our wage earners paid more than the bottom 90 combined. And the top 3% of our taxpayers, as measured by their income, paid 51% of the income tax. That's reality. And we have this pervasive mantra that says that the wealthy aren't paying their fair share. Unfortunately, nothing could be further from the truth. And the proposed tax increases that the Biden administration is talking about will further increase the tax burden on the wealthy, which in the long term is not going to be healthy for our economy. We do see continued gridlock. We are at this moment, we're making the assumption that the Republicans will maintain control of the Senate. That's not a guarantee. There's a runoff election, I'm sure, as everybody knows, in Georgia in early January. But it appears pretty certain at least one of those senators elected in Georgia will be a Republican, giving them a no worse than a 51-49 advantage. We do think gridlock is not necessarily a bad thing. If you go back to 1960, the time periods in which there was a split, a House, Senate, and/or presidency, the returns of the stock market actually outperformed the times when there was unification between the Senate, the House, and the presidency. So gridlock is not necessarily a bad thing because things don't change a whole bunch when there's gridlock. China is a big wild card. Without any question, we are in China's gun sights. They want to become the preeminent military, economic, and political power on earth. They are gaining rapidly on us. And there's some concern that the way Biden might treat China in some ways could be more negative towards those objectives than what Trump was doing. So we really need to keep an eye on how Biden and his administration treats China because they are the 800-pound gorilla now. We're still bigger and better, but they're closing the gap. It looks like we've been able to answer all the questions that have come up during our presentation. So I would just have everybody take a look at the panelists that were all part of this presentation today. And you see the contact information there, both email as well as phone number. We are going to get a copy of this presentation into the hands of everybody who attended. So you will have this contact information. And I guess I would just say that I joined my father's insurance agency back in 1979, and I was employee number 5. We now have, I believe, 110 employees. And we got there by providing all these different financial planning services. We talk about investments, income taxes, retirement income planning, estate planning for individuals, business perpetuation, and exit strategies for business owners. We wrap that all together in a comprehensive plan to help people form and monitor and ultimately achieve their financial goals. Our tagline is, we make it all work together for you, and we intend to continue doing that in the future. We are one of the fastest growing and largest family-run financial services firms in our region, and we have clients to thank for that. We do appreciate the clients' business, and look forward to taking the opportunity to talk to anybody on this webinar who'd like to discuss potentially becoming a client. We'd love to talk to you about that. So thank you all for attending our webinar, and we look forward to seeing you or talking with you in the future.